Hello everyone, hope you all are doing well. It's me Fahad, your ACCA tutor for financial management F9. So today we would be conducting our uh, investment appraisal past papers, that is Trecor company. Okay sir, now moving forward, Trecor company. Trecor company plans to buy a new machine to meet the expected demand of a new Product E. The machine will have the cost of $250,000 and it would last for 4 years. Sir, the life of the machine is 4 years, at the end of which it would be sold for $5,000. Trigger company expected demand for the product is as follows. The company will operate for 4 years, year 1, year 2, year 3 and year 4. And and the demand of the following years are as follows: 35,000 for the first year, 40,000 for the second, 50 for the third, and third to 25,000 for the fourth year. The selling price are expected to be $21 per unit, and the variable costs are expected to be $7.8 per unit, and the fixed production overhead would be fixed to rupees to $25,000 per year. Will be incurred. The selling price and the cost are all in the current price term, sir, which means that needs to be inflated. It is not inflated yet, sir. If it is not inflated yet, when the examiner say it is in the current price term, it means, sir, our prices have not been inflated yet. Okay, sir. Then moving forward, the selling price and the cost are expected to be increased as follows. The selling price of the product E would increase by 3% per year, whereas the variable cost would be increased by 4% per year, and the fixed production overhead would increase by 6% per year. We also have the other information. Quicker company has a real cost of capital of 5%, 5.7%, and pay the tax at the rate of 30% per year in areas. It can claim a capital allowance of 25% reducing balance method, and the general inflation is expected to be 5% per year. Kicker company target rate of return would be 20%. Depreciation is on the basis of straight line basis and over the life of an asset. Okay, sir. Before starting the question, you need to understand the difference between a nominal and real. Sir, there are two types of cash flows. Number one is the nominal, and the other type of cash flows is real. Nominal cash flows are those cash flows uh, which which is inflated, whereas real are those cash flows which has not been inflated, yet. Okay, sir. Nominal cash flows shall be discounted using a nominal discount rate, whereas the real cash flows shall be discounted using a general discount. Sir, what do you mean by general discount rate? Sir, general discount rate is the rate which has not been inflated yet, and nominal discount rate is the rate which has already been inflated. Okay, sir. Hopefully, you understand the difference between a nominal and a general inflation rate. I would also like to tell you, sir, there is one Fisher rule. There is one Fisher rule that sir, that says that 1 plus nominal rate is equals to 1 plus real rate into 1 plus and general rate. Sir, when you multiply general rate with the real rate, it comes out into a nominal rate. This equation has been derived through the Fisher rule. It is known as the Fisher rule. Okay, sir. I think that we should start the question. If you have any query, you may ask me now. Okay, everyone. It's clear. Shall we start the question? No issue. You may read the question. Okay, sir. I think we should start it. Sir, we have three requirements. Requirement number A, we have to calculate the net present value and advise whether it is feasible or viable to accept the project. Part B, we have to calculate the return on capital employed, which is also known as the accounting rate of return, and comment whether we should uh, invest in the project. And part C, discuss the strength and the weaknesses of the internal rate of return, which is also known as the advantages and disadvantages of internal rate of return. Okay, sir, I think we should start the question. We have here, we have 4 years, so I would say 1, 2, 3, and 4. Okay. Sir, because tax is paid in areas, so I also have to write in year 5. Then we have demand. We have a demand in year 1 of 35,000 units, year 2 of 40,000 units, year 3 of 50,000 units, and year 4 of 25,000 units. Okay, sir. Now moving forward, we have no demand in year 5. Then instead of writing selling price, I would directly conclude to sales. Sir, our selling price is 12 per unit, is equals to 12 per unit into number of units. We have 35,000 units, so it's simply 12 into 35,000 units. Then, so we also have a general inflation rate, which is calculated in the current price term, which means from year 1, that is 1.03. Okay, sir. Then we would apply all this to second year. 12 multiplied by 40,000 and into raised to the power 2. Sir, because it is inflated twice in the year 1, year 2. Then similarly, we have the sales for the third year is 655,636. Sales for the year would be 337,653. Then we would subtract the variable cost of production and fixed production overhead. Variable cost, so we have a variable cost of I would say the variable cost of 7.8 per unit. So 7.8, we would 7.8 into, we have number of unit of 35,000. My variable cost is being inflated by the rate of 4%, so I would multiply it by 1.04, bracket close, and raise to the power 1. Okay, sir. I will close the bracket. 1.03 raised to the power. Okay, sir. Similarly, I would copy the formula and drag it to the A5. of all our variable costs. Then it concludes to contribution margin. Margin the sales less variable cost would be our contribution margin, that is 148. Then for the remaining years it would be as follows. Then so there's a fixed cost. Fixed cost, so we have fixed cost of 25,000 in the year one. So I would write 525,000 in year one. Then it would be inflated by the rate of 6% each year into 1.06. Actually, sir, into 1.06 for the first year. So, so our second year would be 28,090, and similarly, our inflation for the 3 years would be 31. Fourth year would be 31,562. Then, sir, uh, we have already concluded sales, variable cost, contribution margin, fixed cost. Then what the examiner says that there is a real cost of capital of 5.7%. Okay. Then general rate of inflation would be 5% per year. Okay, sir. Then reducing balance method. Depreciation is charged on the basis straight line basis over the life of an asset. It can claim capital allowance on a 25% using reducing balance method. So, sir, we have to calculate a capital allowance schedule. First, I would like to calculate. Sir, our operating profit would be contribution margin less fixed cost, that is 122,180 for the first year, 143,683 for the second, 187,164 for the third, and 77,968 for the fourth year. Then, sir, we have to make a capital allowance schedule. So here is the year column. Then we write depreciation. Then, sir, we write tax benefit. Okay, sir. We have a cost of rupees 250,000, and we are also having a scrap value of 5,000. So we have 5 and 2, 3, 4, 5 here. Then depreciation for the first year would be the amount of the machine is 250,000 into reducing balance method at the rate of 25%. So it is 62,500 for the first year. Then it is 46,875 for the second year. Then similarly 35,156 for the third year, and then for the fourth year we would need carrying value, it is 250,000. Then depreciation would be, sir, so depreciation for, if you accumulate the depreciation for 3 years it would be 144,531. then we would calculate the written down value, or written down value. So our written down value is 105,469. Then from written down value we would exclude our scrap value. Our scrap value, sir, is rupees $5,000. Then the remaining amount, remaining depreciation. So the remaining depreciation for the fourth year would be 100,469, 100,469. And similarly, sir, we would getting a tax benefit of 30%. I think so it's 30%. Yes, sir, it is 30% in areas. it would be 30% in areas, so it is 30% for first year, 30 for the second, third, and the fourth year. Similarly, sir, we would write tax paid on our accounting profit. Sir, we would paid in areas, so the tax for the year 1,122,180 would be paid of 30% in the second year. Sir, because it is an outflow, so we would write in negative. Similarly, our 4-year cash flows are as follows. Then we are having a tax benefit, so I would simply link this benefit over here. 18,750 for the first, 14,063 for the second, 10,547 for the third, and similarly 30,141 for the fifth year. Then sir, we are having a working capital. I would like to write a working capital over here. We have a working capital of 250,000 in the year 1. Then after 4 years we would be receiving a scrap value of 5,000. Okay sir. Then sir, after adding all of these we would get a net cash flow. Sir, we would get a net cash flow of rupees of dollars, sir, amounting to of 250 for the first year 0, 112 for year 1, 125 for year 2, 158 for year 3, 37, and 6750 for year 5. Okay sir, then we would use discount rate. Sir, for calculating the discount rate you need to just have another working, need to calculate another working, which means 1 plus nominal rate is equals to, is equals to 1 plus real rate into multiply it with 1 plus general rate. Okay sir, then the real rate, Trecor company has a real cost of capital, you are having a real cost of capital of rupees, so I would simply 1 plus n is equals to, you are having a real rate of 1 plus 5.7 percent, sorry, it's percentage 5.7%. Okay, so you would be having 1 plus 5% is equals to 5.7%, so you would be having 1.057. Okay sir, then moving forward you would multiply it with 1 plus general rate. So general rate you are having 1 plus, what is the general rate that you have that the examiner has given in the question? The general rate is expected to be 5% per year, so you would 1 plus 5%. We simply close it, then we will having 1.05. Okay sir, then for inflation 1 plus nominal rate is equals to 1 plus 1 plus n is equals to, sir, 1.057 is multiplied with 1.050, then you will get 1.11. For the nominal rate n remains here, but it's the positive one will go after is equals to, it will become a negative one, so sir it would be 1.11 minus 1, so the answer is, your nominal rate would be, sir, would be approximately to 11%. Let me convert in percentage, so it would be, sir, 10.99%. Okay sir, your rate is 10.99%. If sir you have already inflated the cash flows, then you would use nominal rate, discount rate. If you haven't, specifically inflated the cash flows, then you would use your general rate. The answer of the nominal rate and general rate would be same if you haven't inflated or you have calculated it rightly. Okay, sir. Then for calculating the inflation, the discount rate, we would use 1 plus 10.9%. So it's 10.9. Oh my god, 10.9%. We fix it. Then raised to the power. And for power, we would be having minus number of year. For example, sir, we are having year 1. So for net present value, we would simply multiply the net cash flows with the discount rate. After multiplying the net cash flows with the discount rate, we are having net present value. So, we would simply add all the net present values of each of the year. The net present value after after adding the net present value of each of the year, we are simply getting 106,499. It is our net present value of the project. So you also have to advise whether it is feasible to accept the project. Yes, sir, it is feasible to accept the project because you are having the positive NPV. Therefore, you should accept the project. In part B, so you have to calculate return on capital employed. So return on capital employed (ROCE), return on capital employed, which is also known as accounting rate of return. So in return of capital employed, which means how much profit you would earn by making how much investment. So its formula is very simple. Uh, Average profit is divided by average investment. Average profit is being divided by average investment. So for this, you firstly have to calculate the average profit. Average profit is calculated. Average profit is being calculated by calculating the net profit. Net profit comes from the operating profit. So you are having the operating profit of, so my operating profit is 530,000 and less my depreciation. So the depreciation is for the fourth year is 245,000. Then the average profit would be 530,995 less 245,000. Then it is a net profit, sir. Actually, it is net profit. For average profit, it is our net profit. Okay, sir. For average profit, we would divide our net profit with our number of years, the life of the project, divide with project life. Then simply we would be getting an average profit. So, sir, our average profit is our net profit divided by the project is of 4 years. Therefore, we have divided with 4. It came out 71,498. Then we would calculate our average investment. Average investment is quite easier. For average investment, you simply use your working capital, which is 250,000 divided by average. This means you have to divide it by 2. When I divided my average investment with average profit, it came out 125,000. Then calculating the return on capital employed is equals to, you simply need to divide your average profit, average investment, average profit is 71. and average investment was 125. So your return on capital employed is 0.57. Your return on capital employed is 0.57, which means your target return on capital employed is 20%, and your, let me convert into percentage, and your projected return on capital employed is 57.2%. So because the return on capital employed, the average return on capital employed is greater than the target ROC. So your project your project ROC greater than your target project, therefore it is feasible for you to accept the project. Okay, sir. Hopefully you understand the part B, in which you have to calculate the average profit, return capital employed, which is also known as your accounting rate of return, which means that how much profit you would earn over your invested amount. So, sir, you have calculated your net profit. In firstly, net profit is calculated by using an operating profit less your depreciation. It is my operating profit. Sir, operating profit, you subtract your operating profit, you subtract your operating profit with depreciation. Is depreciation, the depreciation you are getting to 245,000. Then you, after subtracting your operating profit with your depreciation, you get a net profit. Then you simply divide the net profit with your life of the project. You would simply get your uh, I would say average profit. Then you already have an average investment of 250,000. You divided it with 2, you got average investment. Then you, for ROC, you divided your average profit with your average investment. Since, sir, it is greater than your target ROC, therefore you should accept the project. Then in part C, you have to tell the strengths and weaknesses of internal rate of return. Sir, I would just tell you that. Um, Wait a minute, sir. I think I have opened it. Yes, sir. Here it is. Sir, you have an average uh, target profit, advantages of internal rate of return, sir, which mean it consider time value of money, whereas other methods such as payback period does not consider time value of money. Sir, it is a cash flow. It is not based on profit, whereas accounting rate of return, as you have seen, it is based on accounting, it is based on accounting profit, in which you can manipulate or to adjust through your accounting policies. Then the third is it is easy and you can interpret the result. Management can use a percentage to interpret the result. Similarly, sir, it is also having a disadvantage. Means, sir, this method assumes that the net cash inflow generated through the project life will be reinvested to earn the same return, but it is not possible in a real life, as you know before. Then so if there is a two project, for example, one project which is earning 4 lakh and the other project which is earning only 40,000, both the projects would also have the same internal rate of return. Therefore, it would not be feasible for you to select between two of the project. So similarly, you would also read it earlier. Uh, when you have two types of cash flows, one the conventional and other the non-conventional cash flows. So, sir, it would for two non-conventional cash flows means, for example, you would having a negative cash flows and some positive cash flows in between. So you would need to calculate a 2 IRR. Your 1 IRR would not be feasible. Okay, sir. Another disadvantage of this is that the when there's a mutually exclusive project, for example, when you have two project, a project A or project B, if you have to choose in one of the project in between, it is not feasible to suggest which project will give you more profit or more return. Therefore, I think that it is not feasible. These are the advantages of internal rate of return. Okay, sir. Hopefully you understand. If you have any query, you also may ask. Uh, Although you can also refer the ACCA website, in which there is a whole description about the internal rate of return. They've also described the internal rate of return with the graphic representation, and some advantages and also disadvantages of interrelated data. Okay, so thank you. If you have any query, you can also WhatsApp me or write it in a comment. Okay, thank you.